What if the very mechanisms designed to keep things stable, like shadowy trading venues and institutional investment vehicles, end up sparking unprecedented changes that redefine wealth creation? Today, we're diving deep into the dynamics that could reshape how we think about value in cryptocurrency, exploring the intricate web of supply, demand, and innovation surrounding XRP. This is for educational purposes only and not financial advice. Let's jump right into the heart of it. Dark pools and over-the-counter OTC trades have long been integral parts of the financial landscape, serving as discrete channels for large institutions to execute massive transactions without sending shockwaves through public market prices. In traditional finance, these tools allow hedge funds, banks, and other big players to buy or sell substantial volumes of stocks or bonds quietly, preserving market stability. For XRP, a cryptocurrency designed for efficient, cross-border payments, these off-chain venues play an even more pivotal role in liquidity provision. Think of them as hidden rivers feeding into the mainstream of the ocean. Trades happen in the shadows, often involving billions in value, but they don't appear on the typical exchange order books that retail investors monitor obsessively. To understand this better, let's break it down. Dark pools are private exchanges where trades are executed anonymously away from the public eye. OTC trades, on the other hand, are direct negotiations between buyers and sellers, often facilitated by brokers. In the context of XRP, these methods are particularly appealing because the token's utility and global remittances and settlements attracts institutional interest. For example, a major bank looking to integrate XRP into its payment systems might want to accumulate a large position without alerting the market, which could drive up prices prematurely and increase their acquisition costs. By using OTC desks, they can secure deals at negotiated rates, often close to the prevailing market price, but without the immediate volatility. The burning question here is, could these trades actually drive XRP's price higher over time? On the positive side, dark pools and OTC desks enable efficient large-scale transactions that prevent short-term volatility spikes. This efficiency is crucial in a market as nascent as cryptocurrency, where sudden price swings can deter serious investors. For instance, if a pension fund decides to allocate a portion of its portfolio to XRP for diversification, executing that through public exchanges could cause a temporary surge, scaring off other participants or inviting speculative traders. Instead, OTC allows for smooth entry, fostering long-term confidence. Data from market analysis, including reports from firms like J.P. Morgan, suggest that as institutional interest grows, projected inflows into XRP-related products could reach 4 to 8 billion in the first year. These venues experience heightened activity. This increased participation boosts overall demand, leading to gradual upward pressure on prices as the available supply on public exchanges tightens. It's like a snowball effect. More institutions enter via OTC, reducing visible supply, which in turn makes XRP scarcer and more valuable. Moreover, these mechanisms can act as a bridge between traditional finance and crypto. Consider the analogy of a backstage pass at a concert. While the crowd in the arena, public exchanges experiences the chaos, VIPs, institutions enjoy a calmer, more controlled environment. This stability not only attracts more players, but also encourages sustained holding rather than quick flips. Historical data from Bitcoin's ETF launches in 2024 shows a similar pattern. Initial OTC absorption allowed for massive accumulation without immediate price explosions. But as liquidity in those channels dwindled, the spillover to public markets triggered significant rallies. For XRP, with its circulating supply around 60 billion tokens as of late 2025 and a market cap hovering at 130 to 135 billion. This could mean a phased price appreciation starting subtle but building momentum. But let's not ignore the flip side. There's always a balance to strike. Critics argue that the opacity of dark pools and OTC trades can delay true price discovery, where the market's real value isn't reflected promptly. If a substantial portion of trading volume, estimates suggest up to 40 to 50% in some crypto assets, remains off exchange, retail investors might miss out on early gains. The price could lag behind the asset's fundamental improvements, such as Ripple's expanding partnerships or technological upgrades to the XRP ledger. This lag creates an uneven playing field where institutions benefit from insider-like access, while everyday holders wait for the ripple effects. Furthermore, if OTC liquidity becomes too concentrated, it risks creating bottlenecks. Sustained buying could exhaust available supply in these channels, forcing trades back to public exchanges and causing abrupt volatility. Balanced against these concerns is the potential for acceleration. Once OTC dries up, the pent-up demand floods the open market, potentially leading to sharper upward movements. Engaging question for viewers. Have you ever felt the impact of institutional moves in crypto prices? Or do you think retail still drives the narrative? To illustrate, let's look at recent developments. As of November 2025, XRP's price sits around $2.20 to $2.27, with exchange reserves on platforms like Binance dipping to historic lows around 2.79 billion tokens. Analysts warned that with only 3 to 5 billion XRP readily available on exchanges, the influx of institutional demand via OTC could trigger a supply shock. Posts from verified crypto experts highlight this, noting that ETFs alone have absorbed over 200 million tokens in just 11 days, with cumulative inflows reaching $587 million. If this trend continues, the hidden trades in dark pools might not just stabilize, but actively contribute to a price floor, preventing deep dips while setting the stage for climbs. Shifting gears to ETFs and their profound impact on XRP supply, exchange-rated funds are absolute game changers in this space because they institutionalize demand in a structured, regulated way. Unlike direct crypto purchases, ETFs allow investors to gain exposure through familiar stock-like products backed by actual holdings of the underlying asset. When an ETF launches, the issuer, be it Bitwise, Franklin Templeton, or Grayscale, must acquire and hold real XRP to back the shares, effectively removing those tokens from circulation and locking them away in custody. This isn't just theoretical. Recent data from November 2025 underscores the speed of this process. For instance, Grayscale and Franklin Templeton spot XRP ETFs each clocked over $60 million in inflows on their debut day alone, contributing to a total of $586.8 million in cumulative inflows since trading began on November 13th. No single day of outflows has been recorded. A stark contrast to early experiences with Solana or Ethereum ETFs. This locking mechanism reduces the liquid supply available for everyday trading, creating what experts call a supply crunch. With XRP's circulating supply at approximately 60 billion and daily trading volumes exceeding $4 billion, even modest ETF inflows, say 100 million daily, can absorb millions of tokens. Market observers, including those from Bloomberg, forecast multiple cryptocurrency ETFs launching in 2025, including more for XRP, potentially injecting billions more. Analysis indicates a leverage effect. Past examples from Bitcoin show that 100 million in direct buys can add 10 billion or more to market cap due to multiplier dynamics in thin markets. For XRP, this could translate to rapid valuation growth, especially as 9 U.S. spot ETFs are now live with assets crossing $628 million and absorbing nearly 80 million tokens in just 24 hours recently. The pros of this ETF-driven ecosystem are crystal clear. They democratize access, enabling traditional investors like pension funds and endowments to dip into crypto without navigating wallets or exchanges directly. This broadens adoption, injecting fresh capital and legitimacy. Moreover, the structured demand provides a buffer against pure speculation as ETF holders often adopt a buy-and-hold strategy. On the data front, inflows have surged to 587 million in 11 days, far outpacing initial responses for other altcoin ETFs, signaling genuine interest in XRP's utility for global finance. However, the cons warrant caution. Over-reliance on institutional sentiment means that if broader market conditions sour, perhaps due to regulatory shifts or economic downturns, outflows could exacerbate downward pressure. Not all ETFs are created equal. High fees or thin liquidity in some products might lead to underperformance, and the initial hype could fade if real-world adoption doesn't follow suit. Plus, while ETFs lock supply, they also introduce counterparty risks like custodian failures. Another engaging question: how much supply do you think needs to be locked? Perhaps 10 to 20% of circulating tokens before we witness a real squeeze that pushes prices into double digits. Delving deeper, consider the multiplier effects in action. If ETFs continue at $50 billion, 100 million daily inflows, projections show they could acquire 20 to 30 million XRP per day across funds, leading to 400 million monthly or 4.8 billion annually with OTC, and dark pools estimated to hold only 1.12 billion available. Depletion could occur in 3 to 6 months, forcing buys onto public exchanges and accelerating price discovery. This isn't speculation. It's math backed by on-chain data showing reserves plummeting. Balanced view. While pros include enhanced scarcity driving value, cons like potential overhyping could lead to corrections if inflow slow amid Bitcoin dominance, currently 58%. Now tying into the intriguing idea of whether holding just 500 XRP could retire your family, it's a provocative thought that captures the essence of cryptocurrency's promise for exponential growth and generational wealth. In the volatile world of digital assets, such claims stem from positioning early in tokens with robust utility and network effects. XRP, with its focus on revolutionizing cross-border payments through speed, 3.5 seconds per transaction, and low costs 0.0002, stands out as a candidate for widespread adoption. Partnerships with banks, remittance firms, and even central banks via Ripple's network position it to capture a share of the $150 trillion global payments market. Let's crunch the numbers based on historical growth and projections. Since its launch in 2012, XRP has delivered over 32,000% returns from early 2013 levels, around 0.0587, to current prices near 220. A hypothetical $1,000 investment back then would be worth $320,000 today. Applying this to 500 XRP at short-term analyst targets of $103, that stake becomes $5,650,000. Useful for a vacation or debt payoff, but hardly retirement material for a family. However, dream bigger with long-term forecasts. If XRP hits 100, plausible if it underpins even 1% of global finance, requiring a $5.6 trillion market cap, given 100 billion total supply, 60 billion circulating. 500 XRP equates to $50,000 invested wisely in diversified assets, yielding 4 to 7% annually. That could generate $2,350 yearly passive income, covering essentials for a modest retirement storytelling moment. Imagine an early Bitcoin adopter in 2013 buying 1,000 BTC at $100 each for $100,000 total. By 2021's peak, that's $69 million, enough to retire generations. Similar narratives abound in XRP communities. Veterans who accumulated during the 2017 bull run or post-SEC lawsuit dips now eyeing windfalls. One anonymous holder shared how their 10,000 XRP stack bought at pennies funded a home purchase. For 500 XRP, it's about conviction. If adoption via ISO 2022 standards and tokenized assets explodes, scarcity from ETFs could propel it to 1,000 plus, turning 500 into $500,000. True family retiring wealth, perhaps funding education, homes, or businesses. Yet balance this optimism with stark risks. Crypto's volatility is legendary. XRP could drop 50% in a bear market, erasing gains. Nothing is guaranteed. Regulatory hurdles like ongoing SEC scrutiny on institutional sales or competition from Swift's blockchain integrations or other ledgers like Stellar might cap upside. Economic factors such as liquidity crises or carry trade unwinds add uncertainty. What are your thoughts? Does 500 feel like enough for generational impact, or would you aim higher, say 5,000 to hedge risks? Remember, diversification is key. Don't bet the farm on one asset. To expand, consider scenarios. In a bullish case, with ETFs absorbing billions and XRP reaching $500, half Bitcoin's 2021 peak adjusted for supply, 500 tokens yield $250,000, enough for a comfortable retirement if paired with traditional investments. Bearish scenario. If adoption stalls, prices might hover at $5, making 500 XRP $2,500. A nice bonus, but not transformative. The key is patience. Historical patterns show altcoins like Ethereum multiplying 5 times in bull cycles without ETFs, so XRP's utility plus inflows could amplify that. Finally, the buzz around launching everything and XRP potentially exploding encapsulates a perfect storm of developments converging to ignite demand. This phrase refers to a confluence of catalysts, new ETFs from firms like WisdomTree, CoinShares, and 21 Shares set to launch, potentially adding 5 and 15 million daily inflows. Expanding use cases in stablecoins like Ripple's RLUSD with 1.2525 billion market cap and tokenized assets on the XRP ledger. Institutional tools such as treasuries for automated liquidity management and upgrades like confidential multi-purpose tokens for private settlements combined with global shifts toward ISO 2022 compliance by 2025. These could transform XRP from a niche payment token to a backbone of digital finance. Pros abound. Rapid launches create unstoppable momentum with current ETFs showing no outflows, unlike Solana's 8 million early dips, signaling rock-solid interest. Data points. Daily inflows in the millions could balloon to billions monthly, straining supply with only 2 to 2.5 billion liquid XRP on exchanges. This scarcity per models pushes prices to $7 to $24 in 60 days from ETF math alone. Institutional adoption, including JP Morgan's 8 billion projection, adds fuel. Cons. Overhype risks sharp corrections if launches underdell or broader crypto sentiment, SAR, and greed index at 15. Regulatory uncertainties or delays in tokenized real-world assets could temper explosions. Watch for whale accumulations, 190 million tokens added in November, and social sentiment turning bullish. Hypothetical. If all 18 to 19 pending ETFs activate, pulling $500 million monthly each, XRP's float shrinks dramatically, potentially hitting 20 to 100 as supply shocks meet demand. Balanced while exciting, encourage own research. Volatility persists. Drop your thoughts in the comments. What part of this excites or concerns you most? If this sparked your interest, hit that like button and subscribe for more deep dives into crypto trends. Let's build a community where we share ideas and learn together. In conclusion, key takeaways. Dark pools and OTC trades provide essential stability, but could delay rallies until supply tightens, setting up explosive moves. ETFs are actively reducing available XRP through massive inflows, priming potential shocks. Small holdings like 500 XRP carry massive upside potential in adoption scenarios, but demand patience amid risks, and the wave of launches signals explosive growth ahead, though balanced with market realities. Remember, always do your own research and consider the full